Do you go for safety or yield? Should you put your money in U.S. Treasury bills or in dollar money market funds? In this video, I'll walk you through the trade-offs in today's rate environment so you can choose wisely. Hey, I'm MindTouch. If you enjoy short, practical finance tips, hit subscribe. Today, we'll compare Treasury bills and money market funds in the U.S., see when one beats the other, and I'll give you a 3-question decision tool you can use right now. Treasury bills, or T-bills, are short-term U.S. government securities with maturities of 1 year or less. You buy them at a discount and at maturity, receive the face value. The difference is your yield. Currently, the 1-year T-bill yield is hovering around 4.1% recent data. That gives you a moderate return with a high degree of safety. Why pick a T-bill? Because it's backed by the U.S. government. Your principal is essentially safe, and you know exactly what you'll receive at maturity. It's a good tool when you have a short-term goal, but don't want to expose your money to stock volatility. Now, let's talk money market funds, specifically government or dollar money market funds. These take your money and invest in ultra-short instruments like Treasury bills and short government debt. Their yields tend to track short rates, minus fees. For example, Vanguard's Federal Money Market Fund has a recent SEC 7-day yield of about 4.22%. That's a good benchmark, not wildly higher than T-bills, but with more liquidity. Here's the reality in the U.S. You're rarely going to see double-digit yields in these safe instruments. So your focus should be on net return after fees and inflation, liquidity, and capital preservation, not chasing sky-high numbers. Let's compare with a numeric example. Suppose you have $10,000. Option A, buy a 1-year T-bill at 4.1%. At maturity, you'd get about $10,410. Option B, invest in a money market fund at 4.22% net. You'd end up around $10,422, but you'd also have flexibility to withdraw anytime, depending on the fund. If you need access early, the money market fund often wins. If you can hold to maturity, T-bills might edge ahead by a little, depending on fees and timing. Here's a simple decision tool. 3 questions. 1. Do I need liquidity and the ability to withdraw anytime? Favor money market funds. 2. Do I want slightly higher yield and can commit to holding till maturity? Favor T-bills. 3. What's my risk tolerance? Both are low risk, but T-bills lean more on safety if held fully. Some practical tips. Always compare net yields after fees of money market funds. Watch inflation. For example, if inflation is 3% and your rate is 4%, your real return is roughly 1%. Use a laddering strategy. Mix 3, 6, and 12-month T-bills to reduce interest rate risk. Consider holding some cash in a money market fund for liquidity and some in T-bills for yield. If you found this helpful, give it a like and subscribe for more U.S. personal finance breakdowns. Want me to run your scenario? $50,000 or $100,000? Comparing T-bills and money market funds? Drop your amount in the comments and I'll make it. Thanks for watching. See you in the next one.